Welcome, everyone. Today's live thought leader webinar is titled, How Operational Headwinds Are Reshaping Healthcare Partnerships, Merger, and Acquisition Strategies. This webinar is brought to you today by Kaufman Hall. This live webinar will last 60 minutes, and at the conclusion, there will be an opportunity for Q&A. To submit your questions, please use the Q&A feature at the bottom left of your Zoom window. Now I will turn things over to our first presenter, Jim Landman.
Thanks, Kristen, and thanks everyone for joining us today. I'm Jim Landman. I'm a Senior Vice President in Kaufman Hall's Thought Leadership Group. And joining me today will be Chris Blom and Courtney Medanik, who are both Managing Directors in our Partnerships, Mergers, and Acquisitions practice. So in terms of our agenda, we're going through a few slides at the beginning. One would be an overview of some of the major headwinds hospitals and health systems are facing today, and then a look at some recent trends that we've been seeing in hospital and health system M&A activity. And at that point, we'll turn this over into a discussion with Chris and Courtney on how they see these factors shaping partnership, merger, and acquisition activity moving forward. So beginning with the headwinds. This first slide, a fair amount going on here, but it really is a way of looking at not-for-profit health systems as a combination of three companies. So first we have the operating company, that is primarily the clinical enterprise with revenues being derived from patient care. Second, we have the finance company, that's responsible for external capital formation, liquidity management, credit management, et cetera. And then we have the investment company that's responsible for generating returns on any invested assets that the health system has. First, that's to meet claims on the operating company or the finance company. For example, with the operating company, if expenses are exceeding revenue, some of the returns can be used to help cover that gap. For the finance company, certainly investment returns can help with debt service obligations. And then second, once those claims have been met, to really pursue independent returns for the health system. Ideally, at any given time, one or more, ideally all three, will be contributing to what we see as the resiliency hub here in the center. And that's really when we talk about resiliency, we're talking about the ability for the health system to withstand any adverse change in conditions. And really through 2021, the operating company has been subject to a fair amount of disruption since the pandemic began. We'll be getting into that in more detail in a bit. But the finance company and the investment company, both through 2021, were doing pretty well. In terms of liquidity, there's certainly some fears at the very beginning of the pandemic, but then relief funding was a big help in really kind of boosting liquidity available to most health systems. We saw, for example, with the three credit rating agencies, we saw median days cash on hand go up fairly significantly over the course of 2021. And through 2021, investments were doing quite well. When we hit 2022, we really ran into operating headwinds that are affecting all three of these companies. So beginning up with the operating company, the volumes in certain areas have really not returned to pre-pandemic levels. Revenues are down accordingly, and what we've really seen, this began really early in the pandemic with the need for health systems to rely quite a bit on contract labor. We have seen operating expenses really go through the roof, and I have a slide on that in just a minute. We've also seen the competitive landscape for clinical services really continue to diversify and grow even throughout the pandemic. And this is, of course, especially in areas outside of inpatient acute care. For the finance company, over the past year, the Fed has been tightening its monetary policy. Yield curves have flattened. Accordingly, there's diminished investor appetite for long-term debt. Just by way of comparison, total healthcare debt issuance in 2022 was $28 billion, and that was down from a trailing two-year average of $46 billion. So almost went down by half. And then in terms of credit and credit management, although the majority of credit rating actions were affirmations over the course of 22, we did see downgrades this past year exceed upgrades across all three of the agencies. And all these agencies now have a negative or deteriorating outlook. That's a new term that Fitch has introduced, a deteriorating outlook for the not-for-profit healthcare sector. So really, there's been a definite turn in the finance company, and as all these companies have been hit, the liquidity issue as well has really started to be affected. We're seeing health systems having to increasingly rely on their reserves, and one of the metrics that we do track as part of our National Hospital Flash Report is days cash on hand. We've seen some fairly dramatic declines over the course of 2022 in that. I think from our 75th percentile on days cash on hand down to our 25th, the declines have ranged from almost 30% to close to 50%. So some real significant changes there. And then, of course, on the investment company, returns have been down, market volatility is continuing. There's pressure for health systems to perhaps elevate the risk for their investments to try to pursue higher returns. Or, as I mentioned, as days cash on hand are going down, to maybe even sell some of those investments to fund capital needs. And so the recent position that the investment company has had in this kind of ecosystem as a resiliency anchor or a balance sheet anchor is really starting to erode. So this is a look at what happened to operating margins over the course of 2022. This is a slide that's derived from our National Hospital Flash Report, where we report on a number of metrics and not-for-profit hospital and health system performance on a monthly basis. So you can see we started 2022 in a very bad place. This was, as you remember, hospitals were dealing with the Omicron variant, and really some of the inflationary forces that started to appear in 2021 were really starting to hit. Problematically, over the year, it really was very difficult for most health systems to pull themselves out of this hole. This is tracking operating margin year to date, and you can see we did not go into a median positive territory until the very last month of the year in December. And even then, that median was 0.2%, which is essentially break even. Just by way of comparison, for the 5 years kind of going up to the pandemic, if you look at like Moody's median operating margin, it ranged from about 2 to almost 3%. So 0.2% is still extremely low. And it also means if that's the median, that almost half of the hospitals that are reporting into our National Flash Report remained in negative territory for the year. So what's been driving this? A lot of it has been expenses. And I'd like you to perhaps focus your attention here on, for each of these metrics, on the dark green bar, which is to the right side for each. And you can see what I've got circled. I'm circling out labor because that was the biggest driver, although you'll see that expenses are pretty much up across the board for all these categories. And what we're comparing here is where we ended year to date 2022. So as of December 22 with year to date 2019. So the last year before the pandemic. So this is comparing where expenses are today versus where they are just before the pandemic began. And you can see total labor expenses up 24%, labor expense per adjusted discharge up 26%. The only area where we see a decline is at full-time employees per adjusted occupied bed. And that's largely driven by the fact that the health systems are facing such staffing shortages today. So this has been the major driver of that poor operating performance, has been this really across the board increase expenses. Now, I don't have to spend a lot of time here. Obviously, any of us who have 401ks or investment portfolios realize what happened to the markets over the past year. They're down approximately 20%. But again, the point is that the investment company had been a real resiliency anchor for health systems, and that position was very much weakened over the course of 2022. Okay, now just to look at what we've been seeing happening in terms of hospital and health system M&A activity. This is, again, an area that we track and report on regularly through the year. We do a quarterly M&A activity report and then a year-end M&A activity report. It's reporting on announced transactions between hospitals and health systems. So you can see one of the biggest trends we saw was a sharp decline in the number of announced transactions during the pandemic. We hit a recent high in 2017 with 117 announced transactions. Then for the 2 years leading into the pandemic, we leveled off in the low 90s. 2022 Q1, it remained fairly high at 79 compared to the last 2 years. Partly because Q1 of 2022 was a normal quarter, and then we saw activity fall off fairly dramatically beginning with Q2 2020 when the pandemic took hold. Then you see we had a low in 2021. Some signs of increased activity, we'll get into this in our discussion with Chris and Courtney. At the end of 2022, we had 53 announced transactions that year, and 17 of those 53 were announced in Q4. The other trend we're seeing, although the number of transactions is down, the size of the transactions is up significantly. One of the metrics we track is the average smaller party size in announced transactions by their annual revenue. And you can see that the average for this has gone up really sharply. We were at 388 million average in 2020. That has grown to an average of 852 million as of 2022. And we just in terms of comparison, we define in our reports a mega merger as a merger in which a smaller party has annual revenues in excess of $1 billion. What we're seeing here is the average across all these transactions actually approaching the size of what we would define as a mega merger in an individual transaction. Then just the last slide I want to show is this figure on total transacted revenue. So this is a figure in which we're combining the annual revenue of all the sellers of smaller parties across announced transactions. And you'll see that we passed, 2017 was that year where we hit the historic high of 117 transactions. And we had 44 billion in total transacted revenue that year. This year, we have less than half the number of transactions, but total transacted revenue actually edged out 2017. We had 45 billion in total transacted revenue in 2022 compared to 44 billion that we saw with that higher number of transactions in 2017. So again, to summarize, one of the big trends we've been tracking in hospital and health system M&A activity, smaller number of transactions, much larger average size of transaction. So with that, I want to go into the discussion with Courtney and Chris. And let's start with some of those early slides on the operational and financial headwinds that we're seeing and its impact on partnership and merger and acquisition activity. So 2022 has been one of the most challenging years hospitals and health systems have seen in a very long time. One of the things we haven't seen yet, however, is an uptick in the number of financially distressed health systems that are involved in M&A activity. It's a metric that we do track in our reports, and it's been holding pretty steady around 15 to 16% of our total transactions over the past few years. So my first question is, seeing what we're seeing in terms of these operational headwinds, do we anticipate an increase in the number of financially distressed systems that are going to be involved in M&A transactions over the next year or two? And Courtney, maybe we'll start with you.
Sure. Thanks, Jim. We do anticipate an increase in the number of financially distressed systems involved in these transactions. And, that we believe that will be driven from the extraordinarily challenges that you just noted. And this is a question that we get often. In fact, I think a board asked me this question just a couple of weeks ago. So, what we're seeing is a shift, and many organizations who for years had insisted upon independence are sort of thinking a little bit more broadly about how they can think about resiliency, as you mentioned early in the slides, and really focus on continued access in their communities. It's important to note that these statistics are a lagging indicator of M&A activity, given how long the transactions take to consummate. So some of the intra-year trend that you mentioned, there was a little bit more pop in activity near the end of the year, might give us a little bit of a sense, but really the distress that we saw throughout calendar 22 may not necessarily show up until later in 23. Chris, other thoughts?
Yeah, I'd say it also depends on what the definition of distressed is. Truly distressed, in default or close to default, we'd expect those percentages to remain fairly constant. Those organizations don't necessarily have the options that even an organization that's experiencing sustained financial headwinds would. So I think we're going to see more of those deals with respect to organizations that are experiencing headwinds, but the truly distressed, probably more constant. But those organizations in the latter a latter category who are contemplating M&A as a means to financial stability, and that's a different dynamic than maybe looking at it proactively as a means to strategic and financial viability and growth. They need to be really thoughtful in how they approach their partnerships, and as a result, the process. Management teams and boards, and we're having these conversations, as Courtney alluded to, need to be thoughtful and deliberate in a dialogue regarding their organization's clinical, business, financial objectives and gaps, and really think through the best course of action and process to identify the right partner, not just a lifeline. So we're seeing a lot of creativity, I think, in structure. Some of that is leading into bigger deals, and some of that is leading into more esoteric non-change of control deals. So there's a lot of activity, I think, Jim, to your prior point, that are happening behind the scenes that aren't necessarily the announced transactions of the last 4 or 5 years, but they're activity nonetheless.
Yeah, it's kind of a follow-up, Chris. One of the things we've been commenting in our reports is that there's been a real change from, let's call it, opportunistic M&A activity opportunities, M&A opportunities, to strategic M&A opportunities, right? And that can have a real impact on the position of a financially distressed hospital and its ability to attract a partner. So what are the challenges that some of these health systems might be facing, and what characteristics are going to make a financially challenged system more attractive as an M&A partner?
Sure, it's a great question. Goes back to the definition of distressed. The fact that any system, when they're seeking a partner, is facing financial challenges and may or likely will be financially dilutive to the quote larger partner, that's the challenge in and of itself. So then the merits of the combination of the deal really rest on the strategic rationale, the better together, I think, as we like to say around here, and that the financial headwinds notwithstanding, which are hopefully at least medium term, but maybe even short term, the partnership is mutually beneficial, can mitigate some of those challenges, and that there's a visible path to financial stability. Those are the types of situations that we're involved in, where we could credibly advise the board that there are options out there that go beyond just, again, a lifeline.
And I think it is interesting to note that we are still seeing a high level of partner interest in those highly strategic situations that Chris just mentioned. And this is another question I think we get a lot of. I think the idea or thought is that there's so much disruption in the market and so much distress that folks will not be sort of showing up in these processes in a real way. And that's not what we're seeing, really. I mean, in situations where there are strategic partners, we're seeing robust activity, actually, in some situations beyond what our expectations were going in. Another looming obstacle, though, sort of back to some of the headwinds faced in these situations and finding a partner, is regulatory scrutiny. There's been a lot of press around, the FTC communicating a hard line around certain markets consolidating, despite the fact that the hospital industry, as compared to others, is actually quite fragmented. But that is something that I think is on the radar screen of many.
I think that the silver lining there, other than the headwinds in getting a transaction done or a partnership done, is that it's an accepted reality, Courtney, right? So, boards and teams who would have otherwise been hesitant to engage in a process that would draw regulatory scrutiny are more open to that. And I think we're seeing that too. We're seeing an openness to pursuing a process or pursuing an options examination, even if a regulatory look is imminent. We didn't see that a couple of years ago. True.
Well, let's look at, when I was going through the 2022 report findings, I noted that there was an uptick in activity at the very end of 2022. And I don't want to put too much weight on any one given quarter, but do we anticipate that we're going to see a higher level of activity or momentum building in terms of M&A activity going into 2023?
Sure. Yeah, I think some of it, Jim, and audience is a function of the time of the year. There's always a rush to get things announced or closed in the fourth quarter. I think some of it is a function of the chart we looked at before, where operating margins started to level off from some fairly negative territory, and boards and management teams in particular, who are really focused on that dynamic, can start to be more proactive in a strategic examination. So there's that time of the year dynamic. But yes, we do expect or hope this momentum will continue. We're observing and participating in a lot of board level discussions and retreats that have shifted from pandemic planning and even in some cases staffing planning, although that's a huge overhang as we saw from some of the data, into a refocus on long-term strategic and financial planning and what a partnership could do, or in some cases can't do, depending on the structure and the needs to help fill some of those gaps. So we do think that just that dialogue alone should lead to more partnership activity if all the other macro factors stay in place.
And what do we think are going to be some of the main drivers for health systems over the next couple of years, the main drivers of M&A activity?
So we really expect a variety of drivers, and they sort of fall into both strategic and financial buckets. So we do expect an increase in what we sometimes refer to as tuck-in deals, some of which might be driven by financial distress, or at least some consideration around some of the extreme financial and operating headwinds that you noted earlier in the presentation, Jim. But on the opposite end of the spectrum, we actually expect many more of the mega deals that you showed on the graph, and those have been, of course, growing over time to really unprecedented levels. And we think that more and more large systems are going to look to come together for some of the strategic reasons that we've seen noted in some of the other sort of large marquee deals that we've seen announced in the last year or more. And we think that there's going to be a continued acceleration in what we sometimes call cross-border deals, those that sort of bleed outside of state lines, sometimes not even contiguous states, sometimes hopping over several state lines. So we're expecting more of those, and again, that they'd be driven by strategic reasons, looking to access resources that really neither can on its own. And it's sort of back to that better together idea that Chris noted a couple minutes ago.
How about changes in the structure of transactions that we're seeing? For example, I know over the past year we commented on a potential growth in the number of more loosely integrated partnership structures. Do we see a trend toward that? And what are perhaps some of the pros and cons of pursuing looser integration in the current environment?
Yeah, so I can take that one first. It's important to note, and I think we get this question quite a bit, the statistics that you showed on the graphs a few minutes ago only represent change of control transactions. So, there are, dozens, if not more, transactions that are popping up across all different, shapes and sizes that are what we sometimes call little p partnerships or less than fully integrated partnerships. And we are seeing a wide range of structures that are explored. And if you've talked to Kaufman Hall, you've probably heard us say this before, but we really think that it's important to start with a discussion of the goals and objectives of the health system rather than sort of trying to rush to the answer and say out of the gate, we need to have a fully integrated transaction, or, we only need to partner in this one vertical or service line to really start with, what are the gaps we're experiencing? What are the pain points, and what are the goals and objectives that we're trying to solve for, and design the structure to fit what you are solving for? So, some of your earlier questions revolved a little bit more around the fully integrated deals. And as we said, we do expect to see more of those, but we also really are seeing an acceleration in these more loosely integrated partnerships. And those could be contractual arrangements, all the way through JV and every flavor in between. And again, if you've worked with us, you might see, we often put together a slide with a big arrow on it, and it's got the full continuation of structures from least integrated to most integrated. And we're seeing activity all along that spectrum, many different flavors. And that could be anything from, two health systems working together on a specific facility or service line, and also partnerships with specialty providers who really focus in one area, like behavioral health, home health and hospice, urgent care, lab, you name it. We're really seeing, again, just a variety of flavors. Chris, are you seeing the same?
Seeing the same thing. And I think, one of the advantages of these little P partnerships relative to something more integrated, at least from a process standpoint, is that you can evaluate or run a number of them at a time. So you can endeavor to address a number of different needs, whether that be on the clinical side, on the specialty side. Courtney, you mentioned the post-acute side. Whereas typically in a more integrated merger or acquisition discussion, you're only speaking to that one party. Now, those structures have their limitations too. I'd say, if there is a very large holistic capital need at a health system that can't be fulfilled through borrowing, but rather through, quote, equity or other sources of capital, these little P partnerships typically can't address that. But they can address capital in some cases for specific new projects or joint ventures or even facilities as well. So back to your comment, Courtney, really just it depends on the goals, objectives of the organization and how boards and management teams prioritize what they need and when.
Hey, Courtney, I actually want to go back and touch on the reference you made to cross-market mergers. We certainly have seen a number of those over the past couple of years. As you said, some of them, some are in contiguous geographies, some are not contiguous geographies. We've also seen kind of an interesting trend in divestitures in which larger systems, both not-for-profit and investor-owned, have been withdrawing from smaller regional markets. So I guess the bigger question is, are health systems thinking differently about what defines a relevant market when they're thinking about partnerships or M&A activity?
I mean, the short answer is yes. And so I think maybe where we start here is that, relevancy is a focus, but everyone defines relevancy different, and every situation, might demand sort of a different approach. So for some, the gap or the issue is market scale and relevancy in that way. And so large systems that have grown over time have found that, certain facilities or markets have not achieved that market scale. And that's been the gap. And they find that it's actually mutually beneficial for that, again, facility, region, however they refer to it, to join a different system. And that would be the best positioning to continue to serve those communities. But in other situations, relevancy means something different. For the large cross-market transactions that we've been talking about, there are often broader areas of focus. And that could be things spanning from access to talent, technological resources, enhanced overall capital capacity that can be deployed for broader purposes. We hear a lot about closing or narrowing the gap in disparities of health and other objectives. So those transactions are seeking scale in order to drive relevance and potentially further partner with our other large platforms, in some cases, some of the largest in the country, to address really the very large, challenging issues facing healthcare. Chris, I'm curious as to sort of what you're seeing in this question.
In terms of geography?
Yeah, and just how folks think about relevancy and how that's sort of manifesting itself in the different types of transactions that we're seeing.
Yeah, no, I'd say from a strategic sense, I think we touched on some of this relative to size. Size and the correlation between size and relevancy is changing, and we're seeing, I think, that dynamic you mentioned, Courtney, before deals are getting bigger. I think the bar is been frankly been raised from a geographical sense and how we're thinking about cross-border or cross-state mergers. That definition of relevancy matters too. And I think importantly, the growth opportunities in many respects for healthcare, because they're local, are finite. And that's always been the case. And prior to the wave of consolidation that we've seen arguably over the past 10 years, there were more opportunities available, certainly for more integrated transactions. And now we're seeing that as a function of the consolidation and a function of some of the dynamics we talked about, re-distress and attractiveness of certain partners or not. We're seeing systems really think about, or rethink about what it takes for them to be successful, and how a partner that may have been a perfect fit 5, 6, 7 years ago may not address the needs today. So.
And that you just you've raised a couple of points about size and scale, and of course one of the things we were noting in the introductory slides was how much bigger the size of the transactions has become over the past 2 years. So what do you see some of the factors that are driving this trend, this really rapid growth in the average size of transaction? And do we think that is, if we're going to see continued growth in size of the transactions that are occurring, again, at the horizontal hospital health system level?
Yeah, I think we are. I mean, similar to the comments on relevancy, from a macro perspective, through consolidation and just through natural growth, organizations are getting larger. So if you look at transactions across multiple healthcare verticals, and I argue, the U.S. business, I don't have those stats in front of me, but I'm going to make an assumption. Transactions for the most part are getting larger. Now, the public markets have an influence on that. When the public markets are off 20, 30%, and so much of M&A is in the public markets, you're going to see a dip. But I'm sure if we looked at a chart over time, the average quote target size is getting larger. So that's one dynamic. But the more relevant dynamic in what we're seeing in hospitals and health systems is really a function both of the consolidation, and then I think a realization of what it's going to take to be successful. Pure size and scale matter, but they're not the only input into the equation. Courtney, you mentioned before, intellectual capital, access to talent, all those things start to matter. There are finite resources inside a geography, so need to look outward as we discussed. So I think there are a lot of factors, but it goes back to boards and management teams taking a look, an intellectually honest look, a deliberate look at what they think is going to take, what they think it's going to take to be successful. And 5 or 6 years ago, Jim, maybe to one of your stats, a $1 billion+ organization probably thought of themselves as a consolidator, and rightfully so. And today, depending on the market, they may not be a consolidator. Unfortunately, they may need to think about other options, either big P partnership options or little P partnership options to increase their viability.
And does this growth in scale, to that point, Chris, does that growth in scale have any implications for perhaps smaller independent systems that had chosen to remain independent but now might be thinking about pursuing a partnership?
Yeah, and I want to be careful here. I don't want the audience or organizations to take away from this conversation that bigger is always better and that you need to be big to survive. We're not saying that. I think what we're saying is you need to look at the gaps in your organization and figure out how to fill those gaps. And sometimes a partnership is the solution. Sometimes de novo work or operations or growth or what have you is a solution. But yes, all else equal, if an organization who is experiencing financial headwinds and can't address them on their own and allows them to continue, and they do continue, it could make them less attractive in the future when they do make the decision to partner. So it just goes back to making sure that boards and management teams are taking a look at this fairly regularly, if not quarterly, at least biannually, in their strategic planning to make an assessment of where they're going to be 2, 3, 5 years out.
So as health systems are facing these intensified operational pressures, we have seen a real focus on, have seen them focusing really on their core operations. So I guess my question is, what are we seeing with respect to non-core or underperforming businesses with health systems, areas such as post-acute care, behavioral health, lab services? How are they, how are health systems thinking about these services, and what are we seeing in terms of structuring of transactions around those? And maybe Courtney, I'll turn to you on this.
Sure. So, I really expect that portfolio review and sort of optimizing across the portfolio are going to be major areas of concentration for health systems as we sort of enter here into 2023. We're working with a lot of organizations that are looking to take a step back and look across most or all their verticals and determine the best strategy, whether that means, staying the course, investing and growing in certain areas, partnering, selling, or some combination of all of those. And I think the discussion is really moving beyond what is considered sort of core versus non-core. And in the past, I almost feel like that's been a little bit of a lightning rod question, right? I mean, some folks were sort of taking that positioning as areas that are important or non-important, and that's really not the point, right? All of these areas along the continuum of care are important, but rather sort of what we're saying, and I think more and more organizations are thinking about doing, is taking a step back and saying, given operating headwinds, financial headwinds, our own capabilities, the partnership landscape, the competitive landscape, what's the best way to approach these areas of, and for some, it might not mean the old-fashioned model of owning everything and controlling everything. And it's also important to note that these are not sort of binary decisions where today I own a certain part of my business. And so if I decide that I am no longer going to fully own it, that I will have no say in governance, no say in how these lines are operated. There are a lot of sort of creative ways that you can think about governance. So, what we are hearing more and more, and it's actually really refreshing, is approaching from the core questions like, how is this service line performing today? How is it expected to perform into the future, given both micro and macro factors? Are we as a health system uniquely positioned to own and operate this service line, particularly given competition and sometimes new market entrants? Are we providing the levels of access commensurate with demand? And if we're not, are we willing and able to deploy the capital needed to expand our access points unfortunately, an environment where resources are finite? We need to make hard decisions about where we're going to deploy that capital. And there are some service lines that require a lot more capital, and we just may not be able to deploy there. So I think we touched on this a little bit earlier, but in an increasing number of situations, our clients are thinking about specialty providers who focus exclusively in one area, to see if they might be able to solve for gaps in operating expertise, to drive optimization and continued high quality delivery of care, for access to capital and for access to enhanced patient access. I think there's a little bit of a misnomer, again, that if there's a service line that we're looking to exit or reposition, that means that we're going to limit access to our communities. It can actually sometimes be quite the opposite.
Yeah, I just amplify one of your points, Courtney. Just because you engage in a process to evaluate a particular service line and decide that it's not core, not strategic, or not a priority, doesn't mean you need to lose it altogether. In many situations we're working on, you alluded to this, there are structuring options, re-governance that allow a quote sellor to continue to have influence and certainly access to that service line. And I think, in the inverse, we're seeing the partners whether they be other not-for-profits or commercial for-profit entities, be very willing, in fact, in some cases, insist on making sure there's connectivity back to the health system or the healthcare provider that partnered out. So I think there's both a willingness, ability, and a general understanding that it's not a sale, it's a partnership.
Maybe spend a minute now turning to vertical integration, particularly with respect to physician practices. That's an area, again, where we're seeing a lot of activity. Health systems are facing some real competition in this area. We're seeing private equity investments in physician practices. We're seeing acquisitions of practices by major national health plans or their affiliated entities. So how is this activity reshaping the marketplace, and what strategies should health systems consider to maintain or enhance alignment with physician groups in the market?
It's well timed, Jim. I'm just peeking at some of the questions here, and one of the questions addresses this. So, and for those who have other questions, we're going to do our best, and it looks like we've got time to get to as many of them as we can that we can credibly answer. But to address that, listen, that's no surprise to anyone this webinar that there's been a lot of physician activity over the past couple of years. Private equity activity in particular, if you contrast that to 10, 15 years ago, where private equity in general was probably more focused on tech, med tech, life sciences, et cetera, and less focused on healthcare services proper and certainly healthcare providers. And that's changed just given some of the macro dynamics and physician scarcity and frankly, the financial profile of some of these specialties. But hospital employment is still by far the most prevalent alignment structure of physicians in the United States. I'm going to misquote the stat, but it's probably still upwards of 70 or 80%. Conversely, private equity penetration in any one specialty probably doesn't exceed 6 or 7 or 8%. I think dermatology is probably the most PE penetrated of the specialties, and it's around 7 or 8%. So all in all, physicians still align with health systems, and that's fairly intuitive. The question, just for everyone's benefit, was, is primary care going to be solely operated by some of the big players like CVS and Walgreens and Walmart and so forth? The answer is don't know, to be determined. Those organizations, from a physician perspective, offer a lot of capital. They offer the promise of an infrastructure to practice value-based medicine, depending on the market. And that could be very lucrative for physicians, certainly. And they also promise patient access. And that's really important because, all else equal, we think that's good for the patient, and it's certainly good for the physician. So there's an attractiveness, I think, to that. What those models don't address today, and that doesn't mean that they can't address, in my opinion, would welcome others' thoughts, of course. They don't address some of the physician relationship dynamics that you have with your primary care provider down the street or in a multi-specialty practice. And that multi-specialty practice is an interesting angle because, primary care is offered at these sites, but you still need to find a specialist and have that relationship as well. So don't know, but it's certainly one of the fastest growing portions of the market. And if you see a bunch of, quote, retail stores put up around your neighborhood or market, it's something to be aware of because it's definitely going to draw patients, certainly MA patients right now. That all being said, it's important, similar to the planning conversation that we had, it's important for hospitals to think creatively within the fair market value guidelines and the regulatory guardrails on how to best align with their physician networks, whether that be specialists or primary care. And there are ways, and they're not easy, but there are ways to start to synthesize, certainly some of the infrastructure that these large, well-capitalized commercial entities offer, but also synthesize some of the economic benefits that a partnership with private equity may offer as well. We're starting to have a lot of those conversations, both in our M&A practice as well as our physician advisory practice.
Well, that's the end of, I think, our formal questions, our formal discussion. And we've got a couple other questions that have come in, and we certainly encourage everybody on the webinar to submit any other questions they have. But perhaps before we get into those, just turn to Chris and Courtney and see if you have any kind of final thoughts on our discussion.
Yeah, I can start, Jim. I mean, I think this has been a great discussion, and hopefully everybody has enjoyed it. You know, I think the first takeaway is that we do anticipate a lot of activity in 2023. We're already pretty busy in the year, and I feel like that's the number one question we get asked all the time. You guys busy? You're seeing a lot. We are seeing a lot of activity. Again, some of that hasn't come through in the statistics yet, but I expect that it will. And I guess that leads to the second point, which is I expect that it's going to be a lot of different flavors of activity. It's not only going to be sort of distressed transactions and or these tuck-in transactions, but additionally, some of these very strategic cross-border type of transactions, all the way to the sort of far left-hand side of the spectrum, which would be non-fully integrated transactions, different types of affiliations that, again, seek to pinpoint a problem or issue, but we're really seeing a lot of acceleration kind of all the way across the spectrum.
Yeah. And it's not one size fits all,
right?
By any stretch. And in fact, to Courtney's point, it's more varied than we've ever seen it before. Hopefully, that's coming out of deliberate and proactive planning. If it's not, we are encouraging our clients to start thinking about that. I know there's a lot of other things operationally and staffing and so forth that are keeping folks up at night, but saving time to think ahead. We believe is an important step, so that if you do go down the path of a partnership, that you can be confident that whatever decision is based on facts and circumstances and proactive thinking versus reactive thinking, and hopefully not distress.
Thanks to you both. So as I said, there are a couple other questions that came in. One is interesting. I hadn't really thought about this, but what impact will the FTC proposed rule concerning non-compete provisions have, non-compete provisions and contracts have? Do you anticipate that this will have a negative impact if it becomes a final rule?
I can start, and I can maybe take it from the physician. Yeah. If the question is it going to cool M&A trends or partnership trends, a complete moratorium on non-competes probably will have a shorter term impact as buyer organizations or financial sponsors try to think through other ways to ensure that who they are partnering with sticks around. Frankly, I suspect, and I'm not a regulatory expert by any stretch, I suspect that the safe harbor that exists for non-competes relative to transactions will remain in place in some form. So there's as much as the FTC and the regulatory bodies don't like non-competes for a whole host of very valid reasons, certainly when they're imposed on at-will workers that arguably don't have control of the organization or even can extract intellectual property. It's the point that the safe harbor for transactions will remain. So will it have a cooling effect overall? I doubt it. I just don't have a crystal ball on what's going to happen either. I think if some of the commercial entities prevail, that even a rejection of non-competes will have some asterisks next to it.
Yeah, I agree. I actually haven't heard a lot of chatter about this in the transactions that I'm working on, but I think that the focus will be exactly where you went, Chris, which is the physician contracts, the non-competes. But I would also think, look, everybody's going to be on a level playing ground. I think in diligence, we're going to see a lot more focus and scrutiny on other alignment vehicles with physicians in the market. So that'll be interesting to see.
Right. And non-compete doesn't necessarily mean you can't work and earn a living. There are many different flavors of it. Again, not advocating for them. I think they have their place in some instances, and they certainly don't in others. And I think my hypothesis is the FTC is probably reacting more broadly outside of healthcare to the widespread use of non-competes in situations that 10, 15, 20 years ago, we wouldn't even contemplated using them, and our business wouldn't have contemplated them.
And then another question also, I believe this came in when we were discussing some of the regulatory issues. It's really for large strategic health systems, they're concerned with as they're thinking about M&A with concentration levels in markets that they're operating in.
So I can start on this one. I'm not sure whether the question is sort of, are we concerned by it, or our regulatory bodies? I'll speak for myself. We often show a slide that says, healthcare is getting bigger, and it's comparing some of even the largest health systems in the country with, the Googles and Amazons in the world that are sort of on the fringes and looking to enter the space. And I'll tell you, probably nobody's surprised here. Those organizations dwarf the sizes of the health system. So, from my vantage point, and we've sort of looked at this many different ways, the health system landscape is still highly fragmented relative to other industries in the country. But there is a heightened regulatory scrutiny that, from regulatory bodies on health systems. So I don't see that abating in anytime in the near future. So, there does seem to be a concern from regulatory bodies, but, I guess from my vantage point, I don't have a concern with where this is going. But again, I'm sort of not a regulator.
Yeah, and geography becomes a double-edged sword. I mean, you can make the argument that every state and market is different. And without getting over our skis, there are different dynamics, economic dynamics there. But then that's a double-edged sword, because it is finite, and there are only a certain amount of choices in theory if you want to stay local with respect to your healthcare. So it's hard to say, but I think, Courtney, your point on the relative size of hospitals and health systems to other commercial entities is probably the most relevant one. And if you overlay market share into that, I suspect you'd come to that same conclusion.
And then we've had another question come in, seeing more acquisitions stemming from, for example, nursing home chains in bankruptcy. Any cautions or need for protection you see in this area?
I can start on this one, and we didn't go into this in specificity during our earlier questions, but we are seeing a really steep acceleration in post-acute transactions, specifically with skilled nursing facilities, as well as others in senior living. Some are in bankruptcy and some in financial distress. And in the past, a lot of these transactions were worked on with brokers. And what we're seeing more and more is that health systems are interested in looking at this from a much broader and strategic, or through a more strategic lens. So, what are the implications to our health system if we were to transact some of these facilities? And so best practice from our perspective is to think about this much more holistically. And again, it's an important part of the continuum of care. So thinking through how you can partner these organizations, but still minimize disruption to your organization is of utmost importance. And so we are working on a number of these today. And I think, the takeaway, or maybe caution, I think was the way that the question was posed, is to really think about that and how you're going to partner with these organizations going forward. Chris, I don't know if you've seen other things or have other thoughts.
Yeah, seeing the same thing. I think one of the unique dynamics here is also the facility or real estate component that's embedded in these types of deals that is maybe not as prevalent in other provider endpoints. And the way that these organizations have been structured over the many years. So that's something to be aware of. That could be a good thing in terms of options, but it could be another more esoteric area of caution in that investors or buyers from the other side may have a different view of the quote operating company, and maybe, Jim, back to your first slide, than the property company or the financial company.
Well, looks like that comes to the end of our of the questions that have been submitted. So thanks to Chris and Courtney again for the discussion today, and thanks for you all for attending. And thanks to the AHLA for giving us this opportunity to present. And I will hand the platform back over to Kristen.
Thank you, Jim. This concludes today's program. Thank you all for joining. Thank you again to our wonderful speakers and to Kaufman Hall for this presentation. The live webinar will be disconnected now.